Welcome, Fact Finders, to another episode of G Fun Facts Online. Today, we're diving deep into a fascinating intersection: your brain, your money, and the future of our planet. Ever wondered what really makes us choose to invest sustainably? It's not just about crunching numbers. There's a whole new science called neuroeconomics, and it's revealing the secrets hidden inside our heads when we decide to put our money into environmental, social, and governance, or ESG investments. So what's going on in our brains when we think about money and ethics? Neuroeconomics tells us it's far from a simple, rational calculation. Imagine a little battle happening inside your skull. On one side, you have the prefrontal cortex, the CEO of your brain, responsible for careful planning and logical thinking. But it's constantly wrestling with other parts, like the amygdala, which is all about fear and risk, and the ventral striatum, which lights up when we anticipate a reward. This mental tug-of-war is super relevant for sustainable investing, because we're not just weighing financial profits, but also ethical values and the long-term impact on society. Scientists are using cool techniques like fMRI and EEG to actually see what our brains are doing when we make these choices. They found that different types of trading decisions activate distinct circuits in our brain. And get this, our past market experiences can neurologically prime us, kind of like setting us up to lean towards certain investment behaviors, even if the current situation is different. Now let's talk about emotions. They are powerful, often subconscious, drivers in all our investment decisions, and sustainable investing is no different. Here's a surprising fact. Some studies suggest that when we're feeling down, like sad or angry, we might actually become more cautious investors. This could lead to more money flowing into sustainable funds, which are often seen as safer bets. It's like our mood makes us more risk-averse, pushing us towards investments that feel secure and stable in the long run. Other feelings like empathy, caring about others and the planet, and the desire to feel good about ourselves, our self-esteem, can also nudge us towards sustainable choices. Interestingly, what triggers these feelings can vary. For example, making experienced Japanese investors feel empathetic might make them focus more on sustainability ratings. But for potential German investors, appealing to their self-esteem might be more effective. The key isn't to become emotionless robots, but to understand how these feelings sway us and manage them for smarter decisions. But our brains also have these little quirks, these mental shortcuts called cognitive biases. Behavioral finance, a cousin of neuroeconomics, has shown how these biases can secretly sabotage our best intentions, especially in sustainable investing. Let's look at a few common culprits. First up, loss aversion. We humans feel the sting of a loss much more sharply than the pleasure of an equal gain. This can make sustainable investors hang on to underperforming, quote, green stocks for too long, just to avoid admitting a loss. Or they might sell winning sustainable investments too soon to lock in small gains. The flip side is that the added emotional and ethical value of sustainable investments might actually help soften the blow during market downturns. Then there's confirmation bias. This is when we actively seek out information that confirms what we already believe about sustainable investing, and conveniently ignore anything that challenges our views. Herding behavior is another big one, the tendency to just follow the crowd, even if our own homework suggests otherwise. While a societal shift towards sustainability might make more people jump on the ESG bandwagon, it doesn't mean everyone is truly committed if the market stumbles. Some research even suggests herding bias can discourage young adults from sustainable investing. Watch out for recency bias too. That's when we give too much weight to recent market news, leading to wild optimism when sustainable investments are booming, or unnecessary gloom when they dip. Anchoring bias means we get stuck on the first piece of information we hear, which can skew how we value a sustainable asset. And representativeness bias is judging based on stereotypes. Interestingly, for younger generations, this might actually positively influence their sustainable investment intentions, as they might use mental shortcuts linked to sustainability concepts. Don't forget overconfidence bias, believing we're much better at picking winning sustainable investments than we actually are. This can lead to not diversifying enough or taking on too much risk. And finally, there is willful blindness. This can happen when we have conflicting goals. like wanting to save the planet, but also wanting to maximize our financial returns. The tension can make us ignore uncomfortable truths because they create what psychologists call cognitive dissonance. But here's a hopeful thought. Sustainable investment strategies themselves can sometimes act as a remedy to certain biases by adding that extra layer of emotional and ethical value, shifting our focus to long-term financial and social outcomes. Now for a real head-scratcher. Some research suggests that higher financial literacy might, counterintuitively, be linked to lower sustainable investment intentions, especially among young adults. Surprising, right? It might mean that those who know more about finance perhaps see sustainable options as riskier or less profitable. This tells us there's a big job to do in framing these investments as both ethically and financially smart. So, what can we do with all this brainy insight? For us individual investors, the first step is recognizing our own emotional triggers and cognitive biases. Simple things like keeping an investment journal, playing devil's advocate with our own choices, and focusing on long-term goals instead of short-term market jitters can really help. Financial advisors can use this knowledge to give more personalized advice, helping clients navigate the sometimes tricky emotional landscape of sustainable investing. Policymakers and regulators can design better rules to encourage sustainable finance and protect investors, especially by understanding how market moods affect our reasoning. And financial institutions? They can design and market sustainable products more effectively by understanding these subconscious drivers, responsibly, of course. The field of neuroeconomics and sustainable investing is evolving fast. We're expecting big advances from new neurotech, like more portable brain scanners, which will allow for bigger, more real-world studies. Plus, mixing machine learning and AI with these neuroeconomic models will supercharge our understanding. And it's not just about investing. Neuroeconomics can help us tackle broader environmental goals by giving us a clearer picture of how humans respond to climate change, perceive risk, and make cooperative decisions. This can lead to more effective public engagement and better policies for a sustainable future. In a nutshell, the neuroeconomics of sustainable investing is helping us understand the complex dance between our brains, our emotions, and our financial choices as we try to build a better world. As this field grows, its insights will be priceless in shaping an economy where our financial decisions are not just profitable, but also deeply purposeful, aligning what we do with the long-term health of our planet and society. That's all for today's deep dive on Fun Facts Online. Join us next time for more fascinating insights. Until then, stay curious.